All right, here we are at the beginning of Unit 2. And so in this lecture, we're going to talk about mortgages and redlining. So for the most part, for this topic, we have the lecture, and then there's actually another video that I recorded driving around Oklahoma City, exploring the redlining map that you'll see later with Representative Forrest Bennett. So that map is linked on the page for this topic. Okay, so some of you might ask, like, why are we learning about mortgages in the Introduction to American Government class? And that's a fair question. I think this is not a topic that I typically would cover in a class like this, but I think it works well with some of the things we've talked about earlier in the class and some of the things we might talk about a little later. I would say though, so like this idea of buying a house, one, it's probably the largest financial transaction in your lifetime. It's considered, the American dream to own a house. I don't know if that's still the American dream, but when I was growing up, that was part of the American dream is owning a home. The government has been in the mortgage game for a long time. So, we sort of think of mortgages and houses as a market, but the government is a big player in that. It uses the tax code to encourage home ownership. And that you get some tax savings if you own a home or have a mortgage. Mortgages were a big part of the 2009 financial crisis. And so we're in a big crisis now, but 2009 was also a big crisis, and mortgages and sort of people not paying their mortgages and how the mortgages were packaged was part of that problem. And then mortgage rules, it made it easier to discriminate in the housing market. So it has consequences for this wealth inequality that we talked about previously. So I think government is very much involved in home ownership and mortgages. So I think it's important to learn about how this works. So first, before we get into sort of the government involvement, like a quick primer on how does a mortgage work? So this is similar to how do taxes work? Something, if you want to buy a house, you should probably know how this should work. Okay, so what does a mortgage do? So a mortgage lets you spread out the cost of the price of a home over a really long time period. So the standard mortgage is 30 years. That's a long time period. So most people don't live in a house that long. I looked this up. The average time someone lives in a home is 11 years. But it basically lets you take a big price and spread it out over a long term. So you can make smaller payments over the long term, as opposed to having to come up with all the money at once, which would be extremely difficult for all but the wealthiest people. Mortgages are generally a safe bet for banks because homes appreciate in value, right? So a bank will give you a loan to buy a home, and they know it's okay to make this sort of bet on this financial transaction. So one, if the homeowner stops making mortgage payments for whatever reason, the bank can take the house back. They don't really want to do this. It's a huge hassle for the bank. It's expensive for the bank, but the asset is there, right? So you don't need to come up with some other way to sort of back the loan because the house itself is backing the loan. And homes generally appreciate in value, unlike cars, right? Because if you buy a new car, you drive it off the lot, and most of the time it loses 20% of the value as soon as you drive it off the lot. So again, homes generally appreciate in value. Their worth increases over time, but this is not always the case. The 2009 crisis, if you look at housing values, a lot of them sort of dropped off a cliff. And I personally kind of got caught in this. So I bought a house in, 2007, 2008. And then in the middle of this 2009 crisis, I wanted to move. So I lived in Georgia. My family was going to move to Texas. And I had this house that actually, as it turned out, was probably worth less than the mortgage. So if I were to sell the house, I wouldn't have enough money in the sale to pay the mortgage back. So I actually ended up keeping it, and I rent it out. So I have a house still in Georgia that I rent. So I'm even more sort of wrapped up into this. Houses usually appreciate in value, but not always. If the house is worth less than the mortgage, that's bad for the homeowner, and it's generally bad for the bank. Now, over time, prices have gone back up. So, I'm in better shape. but again, there can be these short-term decreases. So you take out the loan, it's 30 years, and you always pay interest on top of the loan amount. So, and I'll go through an example, but you take out the value of the home minus some down payment and you pay interest. The amount of interest is determined by the rate. So how much you spend in interest is determined by the rate on the loan. These have fluctuated over time. As I'm giving this lecture, mortgage rates are at historical lows. Actually, the 30-year rate, I didn't look it up the last couple of days. It might be somewhere around 3%, maybe lower than 3%. In the 80s, my parents were buying a home in the 80s, and it might have been 13%, 14%. That makes a huge difference in how much you're actually going to pay over the life of the loan. So to buy a home right now is very cheap. The rate you get on the loan is dependent upon your credit score. There's different things that make up your credit score. Some of the things that make up your credit score are like how long have you had credit. So for most of you, if you're students in your 20s, late teens, early 20s, you haven't had credit for a long time. I'm 44. I still look at my credit report and it says like, oh, I'm dinged a little bit because I haven't had credit long enough. Like, I don't know when's long enough. But your credit score determines if you are a risky bet or not for the bank. So when you apply for a mortgage, the bank or the lender sort of does a search on you based off of your social security number, gets your credit score, and that determines for the most part like what rate you're going to get. Prior to credit scores, so credit scores weren't always a thing, you would put on a suit and you go down to the bank. I remember like my parents, were going to move. My parents needed a loan. Like my dad's putting this, I'm like, what are you putting a suit on for? But you go down to the bank, you try to impress the banker. Now they'll look at like where you work and those sorts of things. But it was based much more on personal interactions, I think, than it is today. These rates can stay the same for the life of the loan, or they can adjust. So if you have the rate stays the same, can't go up or down. Some of these adjustable rate mortgages start off low and then they go high. And this also contributed to the 2009 crisis, where people bought homes on a very low rate and then they adjusted up. So maybe it was 3% or 4%, but it adjusted up to like 6 or 7%. And so their monthly payment could go up by a couple $100s. Usually put 20% down on a home. That's sort of like the traditional amount. There's ways to put less. But if you're sort of going this traditional route, I wanted to buy a home in California. So there's lots of places in California that like a home costs $1 million or more. 20% of $1 million is $200,000. So, I know professors at Stanford or some other California schools, and, they're like, great, I get a job at Stanford, and they're really smart people and good professors. And they're like, well, let's buy a home for my family. And it turns out they cost $1 million. And they don't have $200,000 for down payment. So it's a little sidebar, like lots of universities actually have programs where they help faculty buy homes. So a little bit more. So let's just walk through an example. So the median home price in Norman is $175,000. So people are like, oh, it's so expensive to live in Norman, like way cheaper than lots of other places. So let's say you wanted to buy a home at the median price. 20% down is $35,000. So you need to come up with $35,000 in cash for a down payment. And so this leaves a loan of $140,000. You have to pay property tax each year. Let's say it's $2,000 on the home. Usually have to pay insurance on the home each year, $2,000. Now, for whatever reason, for the most part, your property tax and insurance, your mortgage company pays those, mostly because they want to make sure they get paid. So every month, your mortgage company you pay for the loan, and then you also have to pay, it's called escrow. They take a little bit each month, sometimes a lot, to pay for your property tax insurance when those bills come due. Here in Oklahoma, insurance is a lot because we have lots of hail and tornadoes and whatnot. Okay, so actually I wrote this lecture a little while ago. The interest rates were 3.5%. Now they're even lower today. But so let's say we have a 3.5% rate. Your monthly payment is $962. So $175,000 house, $140,000 loan. Your monthly payment works out to be $962. And this is $629 on the loan, and that's interest and principal you're paying back, and then $167 each month on tax and insurance. So there's actually like little calculators you can look up online if you want to figure out like how much would it cost per month to buy a home, and you put in the value, how much the home costs, how much you're going to put down, what do you think property tax insurance are, and so on and so forth. So that will tell you your monthly payment, which is what lots of people care about. What lots of people don't calculate those, over the life of the loan, you would pay $86,000 in interest. So your home costs $175,000, your loan was only $140,000, but because you pay 3.5% per year, over the 30 years, you pay a lot of interest, $86,000. So this is why like banks want to make these loans. The interest can be tax deductible depending on how you do your taxes. If you remember, you'd have to itemize, and then right now, only the first like $10,000, and some of these things are sorry, the state and local tax actually doesn't apply here, but the interest can be tax deductible if you itemize on your taxes. And then actually in the loan, you also pay a whole bunch of fees. Usually these are called closing costs. You got to pay to do some research, make sure like no one else actually owns the property. It sounds surprising, but every once in a while, you're trying to buy something and you're like, actually someone else already owns that. They're not allowed to sell it. They have to do inspections. There are all sorts of fees that are associated with the loan, including one to the bank. So the bank, sort of does all this work for you, and then they charge you for it. So they profit based off of even just giving you the mortgage, the fee. In fact, most banks they give you a mortgage and they sell it to someone else. So they keep the fee and then someone else collects all this interest. It's especially true of small banks. So after 30 years, the house is all yours, and sometimes it's worth a lot. And so this is how most people build wealth. If you think back to the income inequality lecture, is through their home, right? So you might buy a home for $175,000 today. 30 years from now, it could be worth $300,000, $350,000. And so you've accumulated wealth through your home by paying off this loan every month. So either you have the wealth, you might have it on paper, but you still need somewhere to live, right? So if you live in Norman and it's relatively cheap, your house could be worth, much more 30 years from now. Like say when I'm ready to retire, my house is worth more and I have some wealth. If I sell it, I still have to live somewhere. So I might sound like a lot of money, but if you want to be richer, you do want to live somewhere where the houses are cheaper, where you pay less for a house, which might be hard if you're from Norman. Now say you're in California, right? And you bought a house, there's people who bought a house in California 30 years ago for like $100,000. Now it's worth $1 million, right? That's a huge increase in money. They could sell the house for $1 million. And actually what they're doing, the people from California, is they're selling their $1 million home. They're moving to Montana, they're moving to Idaho, they're moving to Colorado, and they're driving up the home values in those places. So for some people, they become wealthy. And other times, like you have this wealth, but if you live in your home, you don't actually can't do anything with the wealth. But when you die, children will probably sell the house and then they get your money through inheritance. Okay, so that's sort of how mortgages work. A little bit on what's the role of government. So government helps people who want mortgages. So the government has decided that they prefer to have lots of homeowners in the country. So there's actually, we don't talk about here, but people who own homes are probably more likely to vote. I'm guessing they have like better health outcomes. Lots of the things we talked about in the income inequality lecture, these sort of benefits accrue to people who own homes. So the government's decided they want people to own homes, so they're gonna help out. It also helps with the economy, right? If people own homes, they buy furniture, they spend money to fix their homes, all sorts of stuff. But so most people don't take loans out directly from the government. You work with a private lender that operates programs that the federal government offers. So there's the FHA, the Federal Housing Authority. And so lots of the way the government is involved in the mortgage market is by insuring the loan. So that means is if somehow, the bank writes a loan and the homeowner isn't able to pay, the government will basically bail out that bank. So whoever has the loan, if it defaults, the government will say like, well, okay, we provide insurance on that and you pay a little bit for this insurance. But it basically backs these mortgages, and we'll get into it in a second, like pushes some potentially risky behavior. So there's a moral hazard. There always is with insurance. So there's FHA loans, VA loans, and actually if you're a veteran, the VA can back your loan. You don't need a down payment. So it lets you get into a home much cheaper than if you had to put 20% down. Now the rates might be a little different, and you have no equity in the home if you don't put down payment. So it's sometimes a little risky, but this came out of the GI Bill in 1944. There's U.S. Department of Agricultural loans, same thing, like insures the loans for rural areas, no down payment. So there's lots of rural parts of the country that really want people to move there. And so the USDA makes it possible by giving essentially cheaper loans. The government, and I say sort of, helps determine the base mortgage rate. So banks could charge whatever they want for the mortgage rate, but usually they think about, there's a 10-year treasury note. So that's something, remember, I think we talked about bonds, that maybe we talk about this later. But you can buy a bond at one price now, and then it's worth a different amount some number of years from now. But anyways, the government sort of sets those rates, and then the banks peg their mortgage rates to whatever the 10-year treasury is. Some of that's actually the Fed. It's a little complicated, but like the government sort of helps determine the base mortgage rate. Sometimes it's through the Fed, which is not exactly the government, sort of, not really. I know I'm not making any sense here. Probably, unless we go into like a whole lecture on like the Fed, the government sort of helps determine the mortgage rate is probably what you want to know. Okay, so the government also created these like companies, and I'm putting quotation marks in here because they're kind of private, but government can regulate them and government created them. So they sort of live in this mishmash world, like between government and not quite government, not quite entirely private. So it's called Fannie Mae, the Federal National Mortgage Association, and Freddie Mac, the Federal Home Loan Mortgage Corporations. Started by Congress to help banks make loans. So there's sort of private companies, and actually like they kind of turn a sizable profit. So this is what they do. These companies, they buy mortgages from the banks. So a bank, let's say like Armstrong Bank here in Norman, gave me a mortgage on my house. Fannie Mae or Freddie Mac would buy that loan from Armstrong Bank. And so they would give Armstrong Bank some amount of money. Armstrong Bank say, here's the mortgage. Fannie Mae and Freddie Mac might resell those to investors because you kind of know like what's the return because you know the interest rate. So it's just a way to invest money. So if you think the interest rate later, you might be able to make money off of this, then you might buy into these sort of mortgages. An investor doesn't buy like a single mortgage, but you could buy like, they kind of package them together. Again, it gets kind of complicated and we'll skip that. Okay, but so Freddie Mac and Fannie Mae, they buy mortgages from the bank, and then the bank has cash, right? Because they sold something and they're like, great, we have this cash, which we do, we should make more loans. And so what the government is doing here is it set up these corporations to make it easier for banks to lend more money. And so our whole economy works on people having the ability to lend money. So the banks can lend money, I can get a mortgage, I can buy a home, I have a house, I go and spend all sorts of money because I need to like put furniture in it and all sorts of things. The government, and this is why like these are kind of private corporations, but not really, they'll bail out Fannie and Freddie if they're in trouble. So let's say Fannie and Freddie buy all these mortgages, and this system only really works if you assume the homeowners are going to like pay their mortgages. But if they can't, and these mortgages that Fannie and Freddie bought are worth less than they were before. And so people know the government will come in and they'll bail out Fannie and Freddie if they're in trouble. So there's moral hazard. So a moral hazard is like you have an incentive to, I don't know, act in a bad way, act in a risky way, more risky than you normally would. So the banks are like, oh, whatever, we'll give anyone a mortgage because we know Fannie and Freddie will buy them. Fannie and Freddie like, well, we'll just buy these because if we mess up, then like the government will bail us out. So everyone wins, I guess, except for the taxpayer and sometimes the homeowner. So this played a big part in the Great Recession. So individuals stopped paying their mortgages because they lost their jobs or they couldn't afford them anymore. And because the variable rates increased, they owed more. But like at the end of the day, the government went and bailed out the banks. And so the banks didn't really lose. But if you lost your house, you did. So, you know, normally the bank, if the person stopped making the payments on the mortgage, the bank would say like, okay, we're going to take the house back and then we'll sell it and we'll get our money back. But the value of houses crashed. And so the house was worth less than the loan. And so this has caused everyone to get in trouble, but the government just came in and said like, all right, we'll just pass some money and bail everyone out. So quick little bit on the Federal Housing Authority. So prior to the Great Depression, government was not really involved in mortgages, and much less so. And mortgages were short, like maybe 5 years. And so what would happen is you would take out, if you want to buy a house, take out a mortgage, and it'd be a 5-year term. And after 5 years, you would renew it unless you paid it off. The stock market crashed and the banks were like, well, we need money. And so they didn't renew them. And so they foreclosed on the homes. And so these very short-term mortgages, people lost their house, and then this sort of cascades itself and the economy continues to crash. So in 1934, the government created the FHA and said the federal government will basically insure mortgages. So this limits the risk of the banks, and the banks have an incentive to make more loans to people. People buy homes, yada, yada, yada. So banks can make money no matter what. Now they make more money if things go well, but they still might make some money if things go poorly. And so the same things happen like when we had the stock market crashed and people lost their savings in the bank. So they also like started to insure people's savings to give individuals like me and you an incentive to keep money in the bank. Because we know if the bank goes bankrupt, our money is insured and you pay for that. Okay, so the FHA is say, okay, we'll insure mortgages, but not all of them. So they had certain criteria. So some loans would get insurance and some would not. And so you basically have to score the homes. There's all sorts of manuals, and we'll look at some of them. And so FHA had some criteria, and you were more likely, the FHA was more likely to insure a loan if it was a large home. And so large homes would score better, and FHA did this because they're like, oh, someone bought a bigger home, they need more furniture, has a bigger yard, they need to buy a mower, right? They want to incentivize people to spend more money into the economy. The FHA said new neighborhoods with similar homes and large lots also scored well. So if you get a higher score, the FHA is more likely to insure the mortgage. And so we can look at on the screen here, there's two different types of neighborhoods. One is sort of a urban city neighborhood. And FHA would not insure loans in cities like this, right? On a street like this. So you could be in a city and they insure the loan. But something like a very, like maybe an apartment that someone would buy. FHA was not interested in creating streets that look like that. They wanted ones to look like these neighborhoods, like think about Norman, like Brookhaven, where every single house looks the same. And there's like 12 Brookhavens. So what the FHA wanted is they wanted these sort of like same homes on big lots in these new neighborhoods in the suburbs. So the FHA basically created the suburb. Because developers knew, oh, I can build this neighborhood on this plot of land, and people will be able to get mortgages for these homes because the FHA will back them. So FHA made these rules, developers created these neighborhoods, and it became the suburbs. This was really accelerated after World War II. Okay, so people have these loans spread out over 30 years. You have small down payments. You do end up paying a lot of interest, but it can be tax deductible depending on how you do taxes. So what this does is the tax code benefits homeowners over renters. So if you're a homeowner and you pay interest on your mortgage, then you can deduct that. And there's some other deductions that you can make, but basically like the tax code incentivizes people purchasing homes. Incidentally, the tax code also benefits owners of rental units over renters. So if you rent, you don't have any tax deductions. I said I have a home that I rent out because I couldn't sell it because it wasn't worth anything. I get to like deduct all sorts of things. I pay someone to mow the yard there. That's the deduction off of any like profits I might make. I can deduct the interest on that mortgage for my rental property. I actually pay someone to collect the rent and fix things if things break. I can deduct that. And actually every year I can deduct part of the home's value. And so, there's all these things built into the tax code that benefit people who own homes. Even if they're renting out to someone else, you benefit. If you're a renter, you don't get any of these benefits. Now, I should say, as the owner of a rental unit, I'm sort of taking a risk, right? And so the tax code also incentivizes people taking financial risks that might create more money in the economy. Okay, so we could argue, and so like a libertarian approach to this would say like, well, the government should have nothing to do with the housing market. Just let it be a market. And I don't know, the free market will figure it out or something. We had that prior to the Depression and it didn't work out pretty well. But anyways, so we could argue, is it good or bad for government to insure mortgages? But I think we should agree if the government is in the mortgage game, they need to treat everyone equally. And so, and when I say everyone equally, I mean like if you present the same risk, right, you have the same income or whatnot, you should get the same treatment. And that's sort of fundamental to our democracy, 14th Amendment, yada, yada, yada. However, when the FHA introduced these rules about backing mortgages, they basically, I'm sure there's some caveats to this. They basically just guaranteed loans in white neighborhoods until 1968. And there's a little bit 77, there's another law that came into place. But starting in 68, they backed off of this. So this is called redlining. And so what the FHA would do is they would literally, and I'll show you an example, take a map of a city, take a red pen, and draw sort of lines and say, okay, people who live on this side of the red line, we will insure mortgages in those neighborhoods. People on the other side of the red line, we will not. And it was usually just based off of race. So for the most part, it was like, okay, these are white neighborhoods and cities. The FHA will insure mortgages here. These are non-white neighborhoods and cities. We will not insure mortgages there. So the FHA, I mean, it was like, this is systemic racism, right? They would say like, well, if you're not white, and you bought a home in a certain neighborhood, it would lower the housing values and make the loans risky, right? And so they basically would say, oh, if you're not white and you want to get a loan in a certain neighborhood, FHA would like, yeah, we're not going to back your loan because that would lower the housing values and make the sort of these loans risky, and the FHA might lose money. So it was hard for, if you weren't white, to get a government-backed loan. So you either had to go somewhere else to get the loan or rent. And these loans like would have higher rates, were like blatantly unfair or illegal, but there's nothing you could do about it. And so this process of sort of the federal government only backing loans in some neighborhoods versus others is called redlining. I pulled this from the FHA underwriting manual. So these are the rules about who gets mortgages or like what neighborhoods would be categorized in a certain way. And so like they wrote the rules down, you can look at them. So first, this talks about deed restrictions. So it used to be perfectly legal to, to sell a house, one person to sell a house to another person and say like, okay, this deed goes with a home. And the deed can say things like, you, the homeowner, can only sell this house to another white person. So you could discriminate on who was allowed to buy the house. The homeowner could kind of like say, well, I'm not being racist. Like it's in the deed. Like, what can I do? Right. And so it's perfectly legal to say, you can only sell this property when you want to sell it to someone of a certain race. Perfectly legal. the manual, and so this manual would say like, well, in which neighborhoods will the FHA back the loans, and which neighborhoods will the FHA not back the loans? If they're not backed, rates are going to be higher because they're not insured. And banks basically, well, I don't want to write a mortgage there because it's risky. So banks would only want to give mortgages in the FHA-backed neighborhoods. But if you start to look in this manual, sort of these ratings on like, will the FHA insure loans in certain neighborhoods, would do things like based off of race. So they would say if adjacent lots or blocks possesses altogether different restrictions, especially for type and use of structures and racial occupancy, the effect of such restrictions is minimized and adequate. So it's saying like you can base these decisions based off of race. Here's more of it. The evaluator should investigate areas surrounding the location. So like they're determining, will we back loans in this neighborhood versus this neighborhood, and looking for incompatible racial and social groups. To that end, an intelligent prediction may be made regarding the possibility or probability of location being invaded by such groups if a neighborhood is to retain stability, yada, yada. So basically someone who's deciding, this neighborhood can be like, well, like there's non-whites in the neighborhood next door and they might move here. So if you're adjacent to a non-white neighborhood, you might be rated less. So they kind of have like, and I'll show you, they had different values, basically like 4, red, yellow, green, and blue. And so if you're adjacent to the quote unquote wrong kind of neighborhood, you might get a lower rating than if you're even further away. And then it goes on to say, like, once the character of a neighborhood has been established, it is usually impossible to induce a higher social class than those already in the neighborhood to purchase and occupy properties in its various locations. So basically what this is saying is, and these manuals are being written in the 30s and 40s, right? It's saying like, well, like if the character of the neighborhood's established, it's probably never going to change. And so that's a very long-term outlook. So it's saying like, well, we're going to establish these ratings in the 30s and 40s, and that's it. We're never going to go back and change them. And so it took a change in the law, some housing legislation to be passed to change the way this works. And generally it's based off of race. Okay, so what happened? So developers want to build homes and they want to sell them to people. They know the only way people are going to buy these homes is if they can get a mortgage, and you can get a mortgage if the FHA backs it. So developers are going to think like, well, how am I going to build homes to make sure the FHA will back them? So they did things. They built walls and neighborhoods build walls and highways between neighborhoods. So if there was a sort of quote unquote desirable neighborhood and quote unquote undesirable neighborhood, and they're like, well, we're going to build a highway through the city. Let's make sure we divide the two areas up. And you'll see in the Oklahoma City redlining map, like the highway that was built sort of goes in between the sort of, again, quote unquote, good and bad neighborhoods. And I don't want you to think I'm saying like this is a bad neighborhood, but like that's how the ratings would look at it. So literal walls. If you've ever been to Northern Ireland, in Northern Ireland, the Protestants and the Catholics build walls between the neighborhoods to keep sort of the other side out. So it's similar to this. What also happened is that real estate agents, they would practice what's called steering, and they would not show homes in certain neighborhoods to certain people. So, you go to this is how you buy a home. You go to a real estate agent, and you're like, well, show me some houses. And real estate agents basically look at you and be like, okay, white person, I'm going to show you homes in these white neighborhoods, or non-white. Yeah, you don't want to look at those homes. I'm going to show you homes in this other neighborhood. It still goes on today, and it's totally illegal. I'll give it, you can read the story here, but yeah, it still goes on today, totally illegal, right? You're supposed to show homes to the people that, the homes they want to see. Whites would only sell to whites, and that was perfectly legal. A way, if you're not white, would buy a home, and one example, and this comes from one of your readings that Ta-Nehisi Coates wrote, is to buy a home on contract from the seller. So say I owned a house and I sold it to someone on contract. The person I'm selling it to makes their payments to me, not to the bank or anything. right, to me, and once you make all of your payments, you own the home. However, the way these contracts are written, say you missed a payment, like, oh, you're out of the house. So you could write a contract that says you miss one payment, you're late with one payment, you're out of the house. I keep all your money, and I kick you out of the house. So you're like out of luck. There's lots of instances where the seller would just say like, oh, you missed a bill, like that didn't exist in the first place, and I take the house back. And so, you let someone live in the house under the system for a few years, collect their money, and then you would say like, oh, you missed a payment, you're out. And then like the police would back you and the person gets kicked out and you just start all over again. So people got pretty wealthy selling these houses on contract. Can't do this now either. Other consequences. The homes in white neighborhoods would tend to appreciate in value much faster. And so we talked about how this is people build wealth. And only whites could buy houses in the white neighborhoods. So whites would build more wealth. They could use that wealth to send their kids to college, give inheritance, and so on and so forth. If you're in a non-white neighborhood, either you didn't own a home or the house did not appreciate value as fast. And so, you weren't able to build wealth as quickly, if at all. There's actually all sorts of, there's instances where I've talked about you pay your property tax. Houses in non-white neighborhoods would actually, in terms of property tax, would pay a higher amount of property tax. So the way they determine your property tax is the government determines how much your house is worth, and then they tax you. So the government would basically overvalue homes in non-white neighborhoods, so you pay more in taxes, and undervalue homes in white neighborhoods, so you pay less in taxes. So you could have the same house in a different neighborhood, and it could be worth more. The government determines how much it's worth. Okay, so here's an example of this redlining map. So this is an actual map, right? You can see the different colors here. This comes from this, if you click on the link here, someone's collected all of these maps from different cities. This is Oklahoma City. So we'll look at this one and the video I have you watch with Representative Bennett. We drive around these different neighborhoods. Okay, and so this is the actual map. So literally just kind of colored in with different markers or pens or whatever. And so we have red. These are called the hazardous neighborhoods. These are the ones that are redlined, absolutely cannot get a mortgage in. We have the ones that they look black. I think that's the way this is scanned. They're actually supposed to be yellow. So if you look at the bottom on the key here, definitely declining. It looks black on this map. The numbers say Y, that means they're supposed to be yellow. Anyways, they look black here. So that's declining. So red is the worst. The next worst is declining. Blue is still desirable, right? So like, okay, we're a little distance away from the good neighborhood. We're in between the good neighborhoods and the declining neighborhoods, but for the most part, not next to the hazardous neighborhoods. There's a couple like kind of weird things that run counter to this. Anyways, I recreated a map that makes it look a little easier to read. The things to look at, like the river here. So this is an older map. The river is different today, so they changed the path of the river, but the river runs through mostly the red or hazardous neighborhoods. And then you notice like there's no highways here. So I think that's Grand Boulevard. I think that's right. That runs around the city, but there's no highways. So this is sort of the actual map. And what I did is actually, this was kind of hard. I recreated the map in Google Maps. So you can draw on Google Maps. You can click on the link on the top here, and that'll actually take you to Google Maps if you want to like sort of scroll around on it. I encourage you to do so too, especially if you're from Oklahoma City. Like, where's your house? You can find certain things. And so, just sort of the big picture here. Oh, this black path that's through here, that's sort of the route I took with Representative Bennett, but not exactly. I meant to do that, and he told me to go other places, so I listened to him. So I don't know, you could ignore this sort of dark, the thick path that goes through the middle here. It's kind of where we started with our routes. For the most part, you can see like the south of Oklahoma City is red, except for this blue Capitol Hill area, which as it turns out used to be its own city. And then it was annexed into Oklahoma City. So that's why it's blue, is because it was its own place and for the most part probably pretty white. And so when they drew the redlining map, they're like, oh, okay, we'll keep this in the still desirable. North Oklahoma City is more likely to be the best, right? And so like we know where the sort of, again, quote unquote, good neighborhoods are in Oklahoma City, the ones with the nice homes, at least the expensive homes. They're in sort of the northern part, Heritage Hills, and so on. So here's a close-up of North Oklahoma City. You see there's this yellow, sort of the like lower tier neighborhood. Actually, it's funny, Google Maps will like record places that I go. I've been to Supercar Win, which is a supermarket. You can begin to see how race matters here. So if you know Oklahoma City, like this is kind of like the Asian part of Oklahoma City. And so it is today. And it's based off of the old map was rated lower. You know, look at some of these neighborhoods, Mesa Park, Edgemere Park, parks, all these parks, right, were rated higher. And it's carried through to today, right? So, you know, in '68, redlining was made illegal, but we still see the after effects, right? The map I showed you, the original map, was from the 30s or 40s. But you can, you know, Oklahoma City still feels the after effects today. And this is the bottom part of the map, right? More red and yellow. I go to Cattleman's too. And so lots of the red is around the highway, right? And so they built these highways like, oh, let's build it through the red neighborhoods. You don't build the highways through the good neighborhoods. And there's Capitol Hill in the bottom there. Again, that was a stone city. I didn't know that. I learned that from Representative Bennett. I don't know that little blue by Cattleman's, why that's blue. The one places we actually see like more development is Bricktown, right? So Bricktown's through here somewhere, and that's relatively recent development that happened. But for the most part, sort of North Oklahoma City, that was rated better in the 40s. You know, the housing values are more. The southern part of the city that was rated poorly in the 40s, housing values are less. So all these things you would expect happened and carried through. Okay, so we'll change gears a little bit. So mortgages are only part of the housing market. There's some cities, and I think this is probably, I think it's less true, comparatively less true in Oklahoma City, where they're in desperate need of affordable housing, right? So again, this is comparable. Some people can't afford homes in Oklahoma City, but like way more people can't afford homes in places like Manhattan, San Francisco. So the median home price might be $1 million, right? That's an unfathomable amount of money for most people. And so this figure here, this map shows you like where are homes expensive and where are homes relatively cheap. And so they base this off of price to income. And so there's, you know, basically like how much of your salary per month should you pay on a mortgage? There's some numbers that are good. But so basically you see this on the coast, right? California coast, up through Washington and Oregon. It's very expensive. Homes are very expensive relative to the amount of money people make, right? So like, oh, people get paid more in San Francisco, like still not enough to buy a home, right? They're not making that much more. And then through the middle of the country, housing values are sort of cheaper relative to income. You see some yellow dots in the middle there. Like there's one in Montana. We see some in Colorado. We see New Mexico. For the most part, that's because people in California are selling their homes and moving there. They're driving up the values. Okay, so we have these cities where houses are super expensive, and you're like, well, what do you do to drive down that cost of something? Build more, right? But in lots of these cities, especially on the West Coast, it's a little less true in New York City. With the West Coast, and I guess not in New York for the most part, East Coast, the local governments make it really hard to build new homes. And this is actually mostly Democrats, right? So the West Coast is very liberal. People say, oh, we need to like make things better. And like, okay, great. Let's tear down your pretty houses in San Francisco and let's build multi-unit homes, apartments. They're like, no, we don't want to do that. Not even tear down an individual's house. But if a builder were to say like, buy a block, right, of homes and pay people. Here's your $1 million to get out of here. You know, like I bought your house. And they're like, great, you sold it. The builder cannot turn around and build like a skyscraper of apartments there because it's not allowed by code. And these cities are you know, mostly run by Democrats. And so the current residents don't want to approve these multifamily units, apartments, because they say it will hurt their property values. I'm like, this is probably not true, right? New York City has huge skyscraper buildings, and it's still like super expensive. In Washington, D.C., you're not allowed, within DC proper, you can't build any buildings taller than the Capitol building because reasons. And so housing values in DC are like exceedingly high because you can't build new houses. And so, or you can't even turn a house into an apartment. And so these local governments put restrictions on the ability to build more housing units, right? So clearly lots of people want to live in these places because the value is high, the cost is high, but the local governments say, no, you can't build any more houses. And then also, like, there's no tax savings for renters like homeowners have. So you might need some sort of government intervention to bring prices down. So something that's happened in California, I think, is the state government is trying to impose on local governments, saying, you know, you have to build so many units of houses that are quote unquote affordable, or they make it harder for localities, place restrictions on building new units. It's actually weird things too in California. Your property tax is based off of how much you bought the house for. So let's say I bought a house in California in 1980 for $100,000. My property tax is based off of a $100,000 home. If I sell that home that's now worth $1 million, let's say I buy another home for $500,000. I now have to pay property tax on a $500,000 home on the new sales price. So this is another part, like how much property taxes are. That's generally determined by the local government. And this is based off of like a 1970s ballot proposition. So anyways, the government's involved both in mortgages at the federal level and then at the local level at restricting how houses are built through zoning. So buying and selling homes might look like a market, but the government is heavily involved in it. It insures mortgages and incentivizes risky loans, provides tax breaks that can drive up prices. For a long time, we had this redlining, which is lots of racial discrimination in the housing market. Like, still goes on some, but less. So less institutionalized, I think, is probably right. And then local policies restrict the number of housing units, and this drives up the costs. So that's it on houses and mortgages, and sort of how the government's involved. So I hope that was both useful as learning how mortgages work, and then how the government is involved in both discrimination and changing prices in homes.